And I present you with three very eager panelists that each of them is going to give them their example of how they have solved the puzzle with the currency selection. I'm very happy and I'm very grateful to the World Bank Treasury for selecting me to moderate this panel. And I think we have a very good basis to make it an interactive and informative session. Now, in the panel, we have three debt managers and one asset manager, and then I'm not counting myself. So this is a puzzle for you to solve. Which of the three is wearing two hats? So I start with the solution. So that would be Jeppe Ladekarl, who is representing his company, First Quadrant, an asset manager in California. So he can wear the hat of the investor, but in his previous life, he was a debt manager for Denmark. So he is able to participate on more than one level in this discussion. To his right, we have Marian Divjak. I hope I got that right, Marian, almost. So there is room for improvement. I'll be the first one to confess that. So he's representing the Ministry of Finance in Slovenia, the debt manager of Slovenia. And he has a number of exciting things to share with us today of his experience. And last but not the least, Patricio Sepulveda. How is that, Patricio? It's okay. So he is the debt manager of Chile. So I think we have a strong panel here today. And just to sort of start us off, I wanted to give a short introductory presentation before we go on to a discussion. And I hope I will not disappoint you that the panelists have not prepared any PowerPoints. So they are actually going to be on the spot to respond to a number of questions I have prepared for them, and also questions from you in the audience. So we have an hour and a half to go through this, and I think it's going to be a very lively discussion. So first I wanted to talk a little bit about the nature of the puzzle that we are trying to solve. And I basically divided it into two. Okay, so what has been happening in terms of global issuance and trends, and what is the problem that we're trying to address? And then secondly, how have debt managers approached the issue? And there's more than one way to solve this puzzle. Actually, it's quite prolific how you can address this problem from so many fronts. So overall, as we know, debt continues to grow, and I've focused here on emerging market debt. I mean, this discussion also applies to advanced economies to an extent. But as you can see from this chart, I mean, debt of emerging market governments and corporates is now close to 20 trillion. A large part of that is obviously China. And as you can see, it's mainly denominated in domestic currency. So this issue and the challenge of the FX risk, at least on a global scale, has subsided somewhat. And the other part to notice is this local currency thing as a share of the total has remained, fairly stable over the last decade, actually. It has been maybe increasing or decreasing a little bit year by year, but these are like very minimal differences. So that's sort of telling us the capacity of the domestic market to provide financing has been increasing and improving. So that would tell me the problem of the FX risk is actually reducing. However, if you look a little bit deeper and you look beyond China and India, the largest emerging markets, local currency bond markets, then obviously there has been a trend, and particularly if you look at the evolution from 2009, and this is the Eurobond issuance of emerging markets, sovereigns actually, you can see there's a jump, particularly in the issuance of low and lower middle-income countries who have been sort of helped by the global liquidity, and many have issued their Eurobonds for the first time, more than one. And then there's also been a marked jump in the upper end and the upper middle income. So that tells us the story that the FX exposure for some of the countries, it's very uneven across countries. So this is still very much an important topic to address, which you can see from the attendance of this breakout session. Now, so what is the problem with the FX volatility? And here, not to offend anyone, I have created an index that's based on recent sovereign issuance by emerging markets. So it's basically weighted by the issuance over the past 12 to 18 months, I believe, that we used as a basis. And you can see if we normalize this trend, obviously there has been a substantial weakening in the emerging market currencies. So with a slight improvement from September, Argentina. And so this is very much an issue, how to manage this volatility and manage the FX risk. But as many sovereigns have experienced, it's easier said than done. So just to get the terminology, a little bit straight, and what is the nature of the problem facing the debt manager, it is essentially thinking about the volatility of the debt service costs. I think that's the sort of the prime issue, the volatility of the debt service, and the impact of FX volatility on budget outcomes. So, in fact, there are two things the debt manager needs to determine. One is going to be the overall share of the FX exposure in the portfolio. And there we face a number of constraints. I mean, what is the capacity of the domestic market to provide the funding that we require? And maybe if the domestic resources are not sufficiently large, what can we do to attract non-resident investors? And so it's not like as pure local currency financing as you might extract from a local pension fund, but it may be the likes of Jeppe and his colleagues who are investing in global emerging markets, non-resident investors that include and introduce new types of risk, volatility in the capital account, the volatility on the FX, and potentially the interest rates as they sort of invest and come back and leave the market. So these are also have a sort of an indirect impact on the FX risk. Now, the second part of the puzzle is actually the composition of the FX part of the portfolio. How actually to extract or to optimize the currency composition, and you can construct some kind of a mean variance models. You can use value at risk. You can focus on the FX. You can include both the FX and the interest rates, and try to achieve some kind of an efficient frontier and select the optimal portfolio. If only life was as simple as this, that would be great. So these are maybe the two key questions that we're going to be posing to the panel here today, especially focusing on the second one. Now, there are more factors to consider. Obviously, it's going to become, country-specific. If a country is having a fixed exchange rate regime, FX volatility may not feature to a large extent. It's going to be quite simple. If you are part of the West African Monetary Union, you can look at euro or the CFA franc, and you say, well, these are essentially the same type of a risk. Unless there is, of course, something some shocks that you suffer, and the FX regime has to be revised. So the risk is essentially a very fat tail risk in the FX, in the fixed FX regimes, and it has an impact on how the debt manager is going to regard this kind of a risk. Now, on the floating exchange rate, obviously things are much more prolific and exciting. You can mark your portfolio to market in the local currency on a daily basis, and and maybe for that set of countries, this issue becomes the composition of the FX becomes more of an issue, and you have to basically try to look to understand the origin of these volatilities and compensate on the composition. Now, there are also other things that can disturb the picture. There can be, contingent liabilities that mature unexpectedly, as it's implied by their definition, and that can, both lead to unexpected budget outflows, but can also lead to liabilities coming onto the balance sheet of the sovereign, perhaps in currencies and maturities that had not been considered before. So these are the unknown unknowns. Now, primarily, the way debt managers have been approaching this management of the FX risk has been looking at the problem from either a stock perspective or a flow perspective. If you look at the stock perspective, you would be more thinking about the overall, the sovereign asset and liability management, the balance sheet approach that is used by a number of countries. Particularly, I'm looking at Herman from Uruguay. That is basically the country that I know that has been in the EM space, that has been able to apply this principle quite effectively. So that would be, looking at the overall balance sheet and, thinking of the FX assets and liabilities across the whole public sector balance sheet. Now, this is easier said than implemented because of the institutional constraints found in many countries and the valuations happening on different balance sheets, but at least it gives you an idea of what your net liability is going to be in each currency, if you're able to extract this kind of information. Now, on the flow side, you can also do a similar type of exercise with the assets and liabilities. You can think of the future stream of government revenue and determine its sensitivity to either local currency or foreign currency, but since most of the revenue is going to be in taxes, the correlation is probably going to be skewed toward the local currency. And then you have other, liabilities, the future, expenditure, and this is covered in the sessions on the SALM, so I'm not going to spend a lot of time there. But essentially, you can think about these flows and how the net composition of this flow is going to be affecting the, let's say, the primary balance. So that is essentially the flow concept. And then you can apply an analysis that basically tries to determine the correlation of the debt service in foreign currency with the primary balance. So this sounds very good and is academically intuitive and fairly straightforward, but much more difficult to apply in practice because of data limitations and also other limitations. And those limitations not only stem from the part of an incomplete analysis, but also basically lack of market instruments and market access to change the portfolio into, the optimal portfolio that you have been going towards. So I think there are a number of things there, and I think Marian is going to mention a number of the challenges related to the hedging. So this is basically the food for thought for the session and the panelists. And with that, I would like to, give the floor to Patricio. I have prepared a number of questions, but hopefully none of them is going to be required, since we have had excellent preparation. So Patricio, if you can tell us a little bit about how Chile has approached the issue and how you would begin to think about solving the puzzle.
Okay, yes. Thank you, Tor, and good morning to everybody. So I think that I will begin the explanation of the Chilean experience first to tell about the evolution of the gross debt, because I think that's very important to understand the analysis that we did in terms of currency composition. So the debt of the government was about 45% of GDP in the beginning of the 90s. So, and we experienced a reduction important, and currently we have a level of about 23% of GDP with a minimum of 4% in 2007. So we experienced effectively over the last 30 years important reduction of our debt. If we incorporate also the assets, so in terms of net debt, also we have experienced an important reduction from the 35% roughly in 2000 at the beginning of the 90s to the current level of about 4% in terms of net debt. So in terms of the debt, this is a level I consider very fair, very healthy level of the debt. But in terms of the evolution of for example, the marketable debt in 2001, for example, the level of this was 7%. Of the marketable debt was only 7%. So and we increased this to the current level of 98%. So we have a very important change to have a very efficient debt management. In terms of the currency composition, also we have been an important change because at the beginning of this century, the local currency was about 7%, and the current level is 82%. So we make a very important change because it was coincident also when I arrived at the ministry. So we begin a change in order to increase the marketable debt and also the currency composition in terms of to have a higher portion in local currency. The first reason of that is basically to reduce the mismatch of the revenue. So this is something that I speak Tor previously. So our revenue, the government is about 85% in local currency, so it makes sense to have also the debt in the local currency. We have some portion of revenue in foreign currency, basically from the revenue coming from the copper industry. So this is one of the reasons that we have this benchmark of to have 80% in local currency and 20% in foreign currency. The other thing, very important, this is also something that Tor, is regarding the investor or the institutional investor available in the Chilean local markets. So in Chile, in the 80s, the asset under management of the pension fund manager was about 5% of GDP, and right now is about 70%. So we have a very important institutional investor in the Chilean local market. They have authorization to issue to invest abroad. The limit is about 80% in foreign investor, but currently they invest not more than 60% in local currency and 40% in foreign currency. Lastly, also, why we have this currency composition is because Chile is a small country. and we need to establish benchmark for the local companies to help to go to the market in good condition. So this is one of the reasons that we issue in foreign currency, basically up to 2014 in US dollar, and then we also include the euro in our composition of the debt. So this is I think the first part of our decision. So benchmark 80% in local currency and 20% in foreign currency.
So to my first question, why the euro? Why? I can understand the 80-20, but why did you select the euro, and what was your main consideration?
So the most important question was effectively this 80%, 20%. The second is effectively why euro, and the decision was taken, I think, in 2014 because we want to diversify our investor base, not only for the government but also for the local companies. So at that time we are showing that effectively we estimate an increase on the rate, and it's still this situation. So we analyze which currency it could be efficient in terms of hedging regarding the fiscal revenue, basically the revenue coming from the copper. And so we analyzed the different correlation between the foreign currency like New Zealand, Australian, Canadian, euro, pounds, etc., inclusive Japanese yen. And our analysis result that effectively the best currency is the commodity currency like New Zealand, Australian, etc. But also when we analyze the currency that could be useful for our local company, we need to also see what will be the market available for our companies. So if, for example, I know if some colleague here from New Zealand, but the market is not available, we consider for the local companies to go to the New Zealand market, and so on. And finally we decide to go to the euro market because this is not the best currency in terms of correlation with the copper, but this is a very good correlation, not the best, but also the market is deep and also available for our local companies. We discuss also with the local companies, the biggest in the Chilean, and also they are also aware regarding it's better to go to the euro than the other one. We also consider the coupon. Of course, the coupon is important, especially when you have a budget constraint. We have in the process of consolidation that we had and we still been right now. And finally we analyze the comparison of the cost in terms of euro to US euro in with cross currency swap in equivalent. Of course, the euro was, and still I understand, is more expensive than the US. But finally, we consider that the other advantage to go to the euro market in terms of diversify the investor base, to have a higher correlation with our fiscal revenue, is compensate the cost. The equivalent cost in US, and so this is the decision that we take at that time to continue and to issue in euro market.
And your currency is still floating, I presume? So you have a floating FX?
Yes,
yeah.
It's floating.
Yeah. So maybe with that, if I turn over to Jeppe, if you can give us a view from the private sector and tell us also what the debt managers could be doing better.
Yeah. So thank you for having me, Thor. This is a great pleasure to be back in my old stomping grounds. It is actually amazing how many parallels that there are between the problems that debt managers are facing when they're looking at their currency exposure for public debt and the problems that institutional investors are facing when investing into markets. I'm not talking about what we do on the hedge fund side in terms of speculation in emerging markets or developed markets in terms of having views. I'm talking about the work that we do with international investors when it comes to managing the currency risk that they have in their portfolios when they invest abroad. And that is actually a very parallel problem that they face compared to what debt managers face. And where it all starts with is basically the idea, or rather the fact, that when you either buy an asset in a foreign currency or you issue a loan, so you have a liability in a different country, you really have done two different things. You've made two different decisions. And those two decisions are separable. And I think that's the important part, because that means that they can be managed differently. So your choice of borrowing in euro is not the same as your choice of having exposure to the euro currency. You can take those two things and basically manage them separately, because if you have a euro liability, then in essence you've done two things. You've gotten a loan in euros, but you've also sold euros and bought local currency. That's the package that you have when you are issuing abroad. So if we think about, and this is the way that institutional investors think about if they're advanced, that is, they think about their investments into emerging markets or abroad, is in exactly in that way. I bought equities, and then at the same time, I actually bought the local currency, right? You're doing the opposite. You're having a loan, and then you're buying your own currency, and now you have extra liabilities in foreign currency. So how does that extra liability actually look like? What are the risks involved in that extra liability that is having sold, say, euro or US dollar and bought your local currency when you've issued the loan? So that kind of depends on your risk appetite and how you look at the risk embedded in that kind of investment in or exposure. And Thor was showing some of the impacts of that exposure, right? When your local currency depreciates, then it's going to get more expensive to service your foreign debt. So that bet turned out to be a bad one. In periods of depreciation. Opposite, in periods of appreciation of the local currency, it gets easier to service your foreign currency debt. What the important aspect of that part of the bet is that the risk of that bet is very large. So the volatility of the currency component is significantly higher than the volatility of, say, the coupon or what is actually changing in terms of the value of the debt that you have outstanding. So you have basically a risk component that is large, it is volatile, and it has large cycles to it. And in addition, when you are in emerging market, you have essentially sold a crisis put option. What do I mean by that? You are short a put option in times of crisis, because there's a tendency for emerging market currencies to depreciate and depreciate very rapidly during times of crisis. And it does not even need to be a domestic crisis. It can be an international crisis. So essentially, you have loaded up on risk, both in terms of having levered up your exposure to your domestic currency when you're issuing abroad in this way, and you levered up on crisis risk. Now, the good thing is that you can do stuff about it because, as I said, these exposures are separable, and you can take or not, leave aside or not the currency risk in the portfolio. So this is very, very similar to the way that international investors are thinking about currency risk when it comes to investments into emerging markets. So it's not just about hedging and hedging during normal times. It's also what kind of hedging that you get in your portfolio when it comes to a crisis and crisis episodes. This has evolved, and Thor was showing some of the data, but this has evolved over time, and in particular, the risk embedded in this bet before, under, and after the global financial crisis has materially changed. And basically what has happened over the last 10 years is that the correlation between emerging market currencies, so that asset that you hold, and your local market and your local economy, the equity market in particular, has gone up. So that means that the diversification benefits of actually holding these assets has gone down. So by getting rid of it, you can actually reduce risk by a lot. So there are some extra current benefits in terms of managing currency risk in these liability portfolios that has increased over time, and in particular post-GFC. And just to give you some numbers, post-GFC, the correlations that we were looking at were around 30%. During the GFC, they exploded and became around 70%, and right now the correlations are 60. So they actually haven't fallen that much post-GFC. So by getting rid of that risk, you can actually dampen volatility on your debt side quite substantially. So there are opportunities here because of that separability. Those opportunities have increased over time in terms of just the market risk that you're seeing. And then the market microstructures have evolved in such a way that there actually are opportunities to transact in the currency markets that are realistic, which they weren't maybe just 20 years ago because of lack of liquidity and so on. But maybe I can get into that a little bit longer at a different time.
No, that's good. Thanks for that. Thanks for enlightening us. We can come back to the sort of the more nitty-gritty, how in fact to put in place these transactions and implement the hedging strategy. But Marian, I think Slovenia has a story to tell also in this, especially in this area.
Yes, thank you very much for the invitation to be here. Actually, indeed, I don't know whether this is good or bad that we have story here to tell. I need to say that the debt of Slovenia was low, rather low before the crisis. In 2008, it was 22% of GDP. As Slovenia was rather badly hit because of financial crisis, this actually increased to 82.5% of GDP in 2015. Since then, we reduced it for 12 percentage points to this year's estimates of 70.3% of GDP. So the composition here is actually that we reduced the US dollar denominated debt from 30% in total debt to 8.5%. This is further to increase next year when one of our US dollar bonds with initial maturity of 5 years is maturing. So this is going well down. Need to say that as far as the investor structure is concerned, there is large share of non-resident investors in Slovenia debt. Slovenia is Euro member country. This distinction is actually here to a certain extent, or could be to a certain extent relaxed, because this is actually our local domestic markets as far as Slovenia is concerned. Still, this ratio is not good, and this is why actually the currency composition going forward is very important. Need to say that because Slovenia debt was low in the past or pre-crisis, we were focusing on local euro market, making sure that bonds are of minimum liquidity, also eligible to be listed on MTS platform. Otherwise, we have a small portion of short-term treasury bills. Also 18 months treasury bills, which is legacy from the crisis, where we executed a certain portion of funding issuing 18-month treasury bills. This would be for this introduction, I believe.
So maybe a little bit more, Marian, on how you have been sort of hedging your dollar exposure. given that euro is your base currency?
Mm-hmm.
Yes, Slovenia actually tapped the global market when it lost market access on the local euro market. So this was the main reason why actually Slovenia went on the global market. Slovenia issued in US dollars in the past, and it tried to issue around Russian crisis in 1998. But situation improved, and then Slovenia issued on the euro market. But then the currency of Slovenia was Slovenian dollar. So we are following the principle here really to fully hedge the US dollar exposure. So we would simultaneously, after pricing or even before US dollar bond, enter into a swap transaction with different banks. So we always did manage, also taking into account that Slovenia had restricted market access also in 2014 when issued two bonds. To compare what is the cost of funding after the swap with actually funding on the euro market. So we would enter into a cross currency position. We use two-way CSA still on weekly basis. Now for cost savings reasons we are moving to daily mark to market, but main principle is really to fully hedge all the FX exposures.
So on the hedging, the cost determination, would you be looking at the benchmark cost of issuing a comparable maturity in euros against issuing a comparable maturity in dollars and swapping into euro, or would it be more like based on, let's say the more qualitative aspect of making sure that you have diversified your investor base, particularly since you had a situation where you needed to do a significant amount of funding in a short period of time?
So in 2012 we didn't really have other choices than to actually execute funding on the global market. But still, I mean, there was secondary market for Slovenia euro bonds. And we were able, after the swap, when we arrived to this synthetic yield in euros, execute funding inside our secondary market euro curve. Same was during year 2013. But as I said, in 2014, we were actually comparing funding opportunities on euro market. After Slovenia successfully actually recapitalized banks and regained market access on the euro market, what the cost of funding in euros versus synthetic euro cost of funding in US dollars would have been. So we were doing better than on the euro market. But it happened that when we started to contemplate our bond issuance in 2014, the difference was still significant. But in February 2014, we were caught during this emerging market volatility crisis when the whole emerging market curve moved up. And then we were still for around 20 basis points better doing funding in US dollars and swapping into euros. So we would actually, in 2014, we started to compare US dollars after the cross currency swap funding to euro funding. These days, absolutely, we would measure what is the cost of funding after the swap compared to with euros. In principle, we measure Republic of Slovenia cost of funding in 4 different currencies and compare it across the curve in different tenors to euro funding.
So, Patricio, I mean, you mentioned a number of important things. One, when you look at your portfolio, to me, it's sort of a trade-off of like a qualitative factors. You want to establish the benchmark in euros for other borrowers. But I'm also interested to know if you have used any models or created any models for deriving the currency composition. And you mentioned the New Zealand, the correlation with the commodity based currency and the correlation with the New Zealand dollar, for instance. And what Jeppe said, how you would basically separate the funding decision from the currency selection. Whether you have used any derivatives, any FX swaps, basically to swap some of the euro part into other currencies, and how that might sort of improve the risk characteristics of your portfolio.
Yes, thank you, Tor, for the question. So in general, we try to avoid derivative transaction. In the past, when I was in the ministry since 2002, we performed many derivatives in 2003 up to 2005, basically swapped to fixed to floating rates, and also we swapped to some currency to local currency to US dollar in order to hedge our long position in foreign currency that we have. But over the time, we take the decision to try to minimize the credit risk, because of course when you enter in hedging or some derivative, you will have additional credit risk to manage. So we prefer to manage our currency composition directly issuing the debt that we want to have as an exposure. So this is the first one. The second question regarding the quantitative analysis, I think that we have had implemented in the Ministry of Finance some quantitative analysis, but I think that the decision that we take over the time was more about some qualitative decision. So to give you an example, right now the level of our debt is about 70 billion of US dollar. So our decision is to have a curve in US dollar and also in the euro markets. So this 20% that we established as a benchmark is about 15 billion of US dollar. So we try to have in both curve almost 3 points for a level of about 2 billion. So if you multiply 2 billion, you will have almost our benchmark that we have in these two markets. Maybe in the future, if our gross debt increase, we will have a low percentage in foreign currency because we are sufficient benchmark established in the market. So this is more a qualitative analysis, a decision than more a quantitative analysis. In terms of the composition that we have right now for the portion in foreign currency, the current is 55% in dollar and 45% in euro. But this is not an formal benchmark. This is something that only because when we decide to go to the euro market, we saw the market condition and we decide to build a very strong euro curve, and so for that we need to have bond in the maturity representative for the market also, and to be useful for our local companies.
I would like to actually answer to your question too, as far as the models, quantitative models is concerned. So actually, during the crisis, we were actually aggressively reducing the duration of our portfolio. So we executed a lot of short-term funding, in addition to 5 and 10-year US dollar funding. So we went off the cost risk efficient frontier, and we knew that. So we, in other words, we we decreased the duration of our portfolio more than we were able to decrease the cost of funding for the Republic. This was crisis period. During a low yield environment in the Eurozone, we again went off the cost risk efficient frontier, and we knew this because we conducted a lot of liability management transactions when we were exchanging US dollar debt for longer dated euro denominated debt. So actually. And we wanted to arrive to well-distributed redemption profile, which would give us a lot of flexibility as far as funding is concerned in the years to come. So we actually knew what the right points on the curve would have been to be at least close to the cost risk efficient frontier. So we've done this consciously. Only this year. We were actually close to the cost risk efficient frontier. So because we already arrived to this position that we actually were able to execute funding in cost risk efficient way. So definitely we will going forward include also actually foreign debt considerations in the model. So we will need to actually be aware of this, but we will be doing also other strategic consideration, which is to maintain presence of the Republic on the global market, because this is very deep market. Slovenia established excellent track record on this market. It's good to have this opportunity. And there's always question, I mean, how costly it is to leave this kind of market and to be back. But for Slovenia, local euro market is really the main market, and we are to execute most of our funding on the euro market.
So Jeppe, what do you think is the... do you think there is a rationale for debt managers to take a more active approach to managing FX risk in terms of, currency selection? And also, do you think it makes sense for a sovereign that's based in euro to run any other exposures than euro exposures? And I'm thinking of Sweden. Sweden used to be an example where the debt managers were taking a fairly active approach to both determining a component of the portfolio should be denominated in foreign currency, but also actively selecting the currencies within that within the currency mix and creating the efficient frontier, and also, if I recall correctly, establishing some kind of external benchmarking on that. Don't know if your memory is better than mine, but maybe you can give some perspectives.
So I don't know if my memory is better than yours, but I do know what they're doing. So you can look at the different ways of managing these portfolios along a continuum, right? And there are different objectives for issuing government debt, right? The primary one is to finance the budget deficit, but then the second order objectives come into mind: broadening the investor base, lowering cost, lowering risk, so on and so forth. And in the case of Sweden, they have gone to the extreme when it comes to their approach to managing the financial risks that they have in their portfolios from the Swedish National Debt Office, or the SNDO point of view. And what they've done is exactly what Thor was describing, that they have built a very sophisticated risk management framework that gives them a starting point for where they want to be in terms of duration, currencies, and so on, to minimize their funding cost. However, they have taken it a step further than that and gone into what some would probably characterize as the speculative space in such a way that they are now actually implementing views on where a currency or an interest rate is going to go at any given point in time, independently of their debt issuance. So there is debt issuance, that is the underlying, and then they're basically saying, okay, we want to manage that portfolio. So now you can see it as a portfolio of liabilities, and instead of managing it to maximize return, you're managing to minimize costs. And doing that by basically buying and selling both currencies and futures in the currencies that they issue to minimize the cost. And they do this internally, so they have an internal team that is basically speculating in currency, speculating in rates, and then they also have external managers that they use for various reasons. One is, of course, to help indeed minimize cost, but also to gain market intelligence and for benchmarking purposes when it comes to their internal program. So they have gone in a very specific direction when it comes to very actively managing the risks in their portfolio. I would say exactly as a hedge fund would manage that kind of exposure, but then limit it to the exposures that they have on the issuance side. So it's not everything goes, but the currencies that they have issuance in, they allow for variations around certain benchmarks in terms of views, and currencies that they have issued in, they allow for duration adjustments on a shorter term scale. So to a certain extent, you can see it as a strategic liability management framework that has been overlaid by a tactical liability management framework, and that tactical liability management framework is actually relatively short term in the way that risk in the portfolio is managed.
What about the currency selection? Like, if you think back in time when you were in Denmark, and think about the portfolio that you had being a sovereign with pegged to the euro. Did you consider having currencies other than the euro in the portfolio, and if so, why?
So the case of Denmark is pretty unique. Well, we all have unique cases when we look at it, but the Danish case is unique in the sense that because of a fixed exchange rate regime with the euro, both before and after the introduction of the euro, right, in terms of whether we were pegged to the Deutsche Mark or it was to the European currency unit or now the euro. There has been a very strict delineation between what is done in terms of funding for budget purposes, that is only done in Danish kroner, and what is done in terms of loans to prop up the foreign currency reserves. So when we're looking at foreign currency and foreign currency borrowing, and Lars, who is in the audience, knows this much better than I, so I'm giving the poor man's version of this. It was done exclusively for foreign currency reserves purposes. So to a certain extent, the Danes have adopted the German approach, which is that you should not be able to inflate your way out of debt. So you're kind of getting into a situation where you, from a fiscal perspective, are putting yourself in a position where you are funding in the same currency that you have your liabilities in. And that's indeed what the Danish situation has been. So when you're looking at the currency component for foreign exchange purposes, that's obviously it has different considerations compared to when you're looking at it for funding purposes. Now, I would say that when it comes to the question that you raised a little bit before, and I think Sweden was an extreme example of a country that has a very, very robust and sophisticated framework. Then when we are working with asset managers and we are working with asset owners in terms of their thinking around how to manage currency risk, it's exactly the same issue. And Thor was posing the question as to whether you use quantitative tools or not. That's actually not, in our experience, the first question that you raise. It's not about whether it's quantitative tools or not. It's about whether you have a framework or not. That framework may or may not be using quantitative tools to come up with a solution, but having a framework is so important, because otherwise you end up in situations where you are making what can turn out to be massive bets that are very low quality, in a situation where you are under stress or where you are not really in the best position to take the decisions that you are in the end are taking. And specifically, I'm talking about currency bets, right? Because currency bets are low quality bets. They're hard to make, but they seem easy to make in your own currency. You think that you have a better view of what is going on with your own currency compared to the world, and that's when you start making issuance and making bets in terms of what you believe that your currency is going to do on a going forward basis. That is very prevalent amongst asset owners. It's a little bit like we believe that we have an edge in forecasting housing markets. We don't, but we believe that we do. Same thing with asset managers and their domestic currency. They believe that they have an edge in forecasting that. It's a very, very hard bet to make. So when you're looking at frameworks, it's better to look at what you can actually control and where your uncertainty around forecasts are smaller. I'm not saying that they're small, but smaller, and that's more in the risk space. So it is hard, but easier to forecast risk than it is to forecast return. So when you're looking at debt composition and currency composition there, getting at it from the risk angle rather than the return angle carries less uncertainty.
So, Patricio, Chile has a lot of sovereign assets. Low net debt, but, sizable sovereign assets in several sovereign wealth funds, foreign currency reserves. Do you consider these assets when you're thinking about your framework and the sort of the overall net exposure in individual currencies?
No, the response is no, not simultaneously, but of course, in my case, I also participate in the investment policy of the sovereign wealth fund, and we perform a similar analysis for one of these funds. This is the Economic and Social Stabilization Fund. Is basically a stabilization fund. We also perform an analysis regarding the currency composition. The best currency composition comparing with the fiscal revenue. So, for example, in the case of the sovereign wealth fund, the result was to issue most of the asset in the Japanese yen, because the correlation is negative with the Chilean activity, but also with the Chilean revenue coming from the copper. In the other side, for the debts, this is the opposite. So the Japanese yen, because the correlation is negative, is not a currency that is convenient to have in our debt portfolio. But and also, independently, also the central bank for the international reserve also perform an analysis, a similar analysis. That's one of the reasons that they invest abroad and also include the Japanese yen and other currency that effectively have a good performance related to the Chilean economic activity, but not simultaneously. So we try. I think that when we take the decision in terms of the sovereign wealth fund investment policy, we not consider the level of the debt and the composition of the debt, and also a similar situation when we analyze the debt regarding the sovereign wealth fund. That's it. Yes, we of course take into consideration, especially the sovereign wealth fund, but not directly. Yeah, I think that indirectly, yes, but not directly. Now,
maybe one last question I have for you, Marian. you mentioned that you wanted to move to a daily basis on the margining, and what a number of sovereigns that I know experience when they move to like a daily mark-to-market, it introduces a new requirement and uncertainty to your cash management. Sometimes the cash management is a part of the mandate of the debt manager, but not always. I mean, how do you sort of manage that challenge?
So this is the most important question as far as the cross-currency swaps is concerned. So you have two choices actually, to do collateralized or non-collateralized cross-currency swaps and other derivatives. So we've decided in 2012 actually to do weekly mark-to-market and exchange collateral with cross-currency swap counterparties in order to reduce the credit charge. So need to say that at that time Slovenia was in very difficult position. The so-called credit value adjusted is calculated based on expected exposure, loss given default, and probability of default. And probability of default term structure is somehow recovered from the CDS curve. So, and this would suggest at the time 100 basis points of additional funding costs for Slovenia. I was lucky that I was preparing this as an analyst for the Republic, and I was strongly advocating really to do this through exchange of collateral to mitigate credit risk. So it happened for Slovenia to be a cost-saving actually approach. So we were able to reduce credit charges close to zero, exchanging collateral on weekly basis. We are now moving to daily margining. Daily margining in comparison to weekly margining would mean only operational issues. So you need to have robust institutional framework. Really, different departments need to work close together. You need to have dedicated team. You need to program internal models to actually check against the calculations of banks, swap counterparties, which are calculation agents for this kind of transaction. So you need to have all this. So this doesn't change, but so it is very big difference. Whether you do this on a collateralized basis or uncollateralized basis. So also in the context of your discussion, you are having huge liquidity risks, having let's say sizable cross-currency swaps behind your balance sheet. In case of Slovenia, I mean, in 2013, when we were in worse possible situation, so we were out of the money also on the cross-currency swaps. So we were doing analysis, scenario analysis. What if euro, which where exchange rate movements represent 70% of the collateral movements, would further appreciate, and actually. This was tricky because we were during the period of providing funding for bank recapitalizations, which were in double digits of GDP. So this is the main problem, and you need to know how you would finance cash collateral which you would need to post. There are other things, there are other approaches, so that you post your own bonds. So we were using proceeds from single treasury account. We manage also the liquidity of the broader state, where all public finance entities are depositing cash. So we had certain capacity there. So the main thing is how you are gonna manage liquidity risk which is coming out of these operations, and this is another reason why Slovenia reduced US dollar denominated debt, total debt, so drastically in the last 2 years.
So I think with that, I'd like to open the floor for both questions and also some insights for solving the puzzle. I mean, we've had very good input here, but I think there may be sort of additional ways to address the challenge of the currency risk management. So, Ed.
Okay, so no, thank you. Extremely interesting panel. So I actually had two questions. One is for commodity exporters like Chile. You did mention copper hedging, and I wondered if that's something you looked at, and it would seem like a way of significantly reducing the risk and then looking at the residual in dollars after that. And then more generally, I guess, when you're thinking about the risk of an FX liability, what's the numeraire? What's sort of the best practice in the numeraire? Strikes me that nominal local currency wouldn't be the best practice, that you might want to use inflation adjusted or percent of GDP or percent of revenues or something like that. But I would be curious to what folks are doing.
Maybe if we can have a couple of questions, then we discuss it in the panel.
Thank you. This is a question for Jeppe and probably for the other panelists. Typically, when we think about foreign currency selection for our debt portfolio, we think of currencies from advanced economies, like euros, yens, even commodity exporters like New Zealand. I wonder what you think about the possibility of emerging markets issuing debt in a basket of other emerging market currencies. I mean, following the same logic that you were talking about investors, meaning if that basket of currencies is weighted in a way that is highly correlated with your domestic currency, then that would mean that you would have a much more stable real exchange rate compared, say, to the dollar.
Just a clarification from this discussion thought that you had with Jeppe regarding Sweden. We are talking about like 10 or 20 years ago, not something that is done right now. Is it correct? I mean, I remember that there were a couple of, they actually had an active, like external managers of part of the portfolio that was handled with derivatives.
That would be yes.
Okay. And
You're looking at it.
Okay.
Mats.
Hello.
Oh, wow.
Yes, coming from Sweden, maybe I have in the position to answer that question from Antonio. And the situation right now, today in Sweden, is that Sweden does not have an external manager. It's just internal management on the debt, on the international and the foreign debt. But the basic framework, as Jeppe described, is the same, looking at the foreign currency risk in the debt portfolio. So Sweden look at the debt portfolio and the foreign currency debt portfolio in the way that first selecting how large part of the total debt should be in foreign currency. And exactly as Jeppe told us, then Sweden looks at how should the distribution within the foreign currency portfolio be distributed among the currencies. So that way you can have two decisions. First, how much foreign currency debt you should have, and then what currency you should have the foreign currency debt in. And Sweden also use a lot of derivatives to have the possibility, at the way that Sweden looks at it, to have one decision on how you should fund yourself, in which currency you should borrow, and one decision what kind of foreign currency exposure you want to have. So it's one decision where to borrow, and one what kind of foreign currency exposure you want to have. So it's two different decisions in that way too. Right now, Sweden has decided to go from a foreign currency composition in the debt of 50%, down to zero. And that was a change, that was a decision that was taken a couple of years ago after using the framework and looking into the risk and cost of having foreign currency in the debt portfolio. And the new analysis come up with the conclusion that it's not adding so much cost benefits, and it's adding a little bit more risk to the debt portfolio. So the decision now is to reduce the 15% down to close to zero, but still being in the market by issuing in dollar, euro, and like that, to be present in the market, to still continue to have the infrastructure in the debt office, because one day it comes a rainy day and you need international market, and then you should be prepared. But still issuing in the international market in foreign currency will not mean that Sweden will have a foreign currency exposure, because that will be taken away by using derivatives. So that's the situation right now.
So maybe for the panel, I mean, we have, what do you think of emerging markets issuing in the basket of other emerging markets? That's a very sort of provocative question. Well, for one, it's like combining the funding with the risk management into one product, and it sort of also touches on the other question from Ed about the copper hedging. You know, why don't you issue a bond linked to copper? I mean, that would be one way to solve that puzzle. Then maybe the more technical question: what should be, you know, an appropriate, let's say, risk measure for the FX risk? I leave that to Jeppe and Marian. So maybe Patricio.
Yes. Effectively, the question is very good. The copper is one important revenue of the government. Also, the economic activity of Chile depend of the copper. Not if you look the breakdown of the GDP by sector, the copper is only 11%. But of course, this 11% you have to add the other sector that depend of the copper activity. When we analyze the situation, it was I'm the minister advisor in the minister since 2002. So I participate of the design of the fiscal responsibility law when we create the different sovereign funds, and the discussion was effectively if we can hedge our exposition of the copper with the market, or if we need to create sovereign wealth funds like a self-insurance. And the decision that, or the information that we take in consideration was effectively that the market for Chile, because Chile is the first producer of copper, and the volume that we produce is too big. If we go to the market, we will impact the market. So we prefer to effectively to have a self-insurance through the sovereign wealth fund. And the way to have this is because when we establish the budget, we establish a long price of the copper. And this long term of price of copper basically is like an hedging for the long run of the price of copper. This is very important because in the long run, for example, if the copper price is right now is a little bit lower than the $3, but if in the long run is $1, you can hedge the price in $3. So we need to adjust the new condition, the new price that we have for the copper. So we also learn, or we try to learn the experience of Mexico, for example. Mexico hedge the budget with the oil price every year for the budget of the next year, and we try to analyze if we can do a mix to have this well fund for the long run of the copper price through the procedure that I told you, and additional to this to go to the market and to buy some option similar to Mexico, but we have the problem that we have. We are too big, so we will affect the price and also the cost. when we quote some volume, I remember 2 or 3 years ago, it was about $500 million of dollars to hedge our revenue from the mining sector. So the cost is too high and also will impact the price. So finally, we decide to continue with our sovereign wealth funds because we consider that effectively if it's a good way to hedge in the long run, and also is allow us to adjust the new condition of the price because it's more efficient. We have also because for the oil price, Chile is in the other side. We have also an import. We import almost 100% of the oil. In this case, we give some hedging for the population in terms of to give some time to adapt to the new price with the system that we built in Chile, because also we have make the same analysis. We cannot hedge for the price for many years. The only thing that we can do is to make some adjustment or to give time to the consumer to adapt to the new condition of the international price.
Maybe, Jeppe, if you can take the question on, does it make sense for EMs to issue in a basket of other EMs? How do you think investors would react to this type of arrangement?
So I love these kind of events. They give me all kinds of good ideas. So thank you for that. When it comes to issuing in a basket of other EM currencies, then you can basically say, okay, what is the problem that I'm trying to solve when I'm doing that? And you're clearly limiting the problem of having basically effectively gone long your own currency against something which is a crisis put in your portfolio. So by doing that, you will have both emerging market currencies. All emerging market currencies will go down at the same time. So you're kind of limiting that kind of prices put impact that you would have otherwise. So seen from that perspective, this sounds intriguing. However, look at the reasons why you're issuing debt in the first place, right? And we heard them already, right? So Max was talking about basically keeping the markets open during a period of time. So you need to be in these markets, and emerging markets are probably not the ones that you will need to have access to at times of crisis. So it solves one problem in terms of the currency risk, but maybe it creates another in terms of actually not providing a solution to what you were looking for in the first instance, which was access to funding and that kind of stuff. Now, I think that there's an interesting parallel, however, that can be taken from it, and this has to do with the. So I painted early on a very naive. So honestly, a very naive picture of what you can do with currency risk in your portfolio. Right? I said it's separable. Max was saying the same thing, and it is in a highly structured, good governance framework like the Swedish one. Right? So it requires really strong governance, strong systems to manage the derivatives and so on. So there are practical limitations for that separability that is coming into play. So liquidity consideration, we are talking about CSAs. I don't know how many of you actually know what a CSA is. I didn't until I really got involved in currency markets. So credit support annex that is there to support derivatives transactions. The cash flow implications that we have from actually having these kind of derivatives in the portfolio, because you have an illiquid asset or liability on one side, and you created liquid liability and asset on the other side. And just to give you a sense for the impact here, a sort of typical derivative from EM into developed market has a volatility that for $1 billion loan would have a like $22 million impact on a monthly basis in terms of payments, either in or out. So for $1 billion, you're looking at $22 million that you need in dollars to support the activity here. okay, times 3, right? Because it's quite prudent to have a sort of cushion for shocks. 3 standard deviation. Okay, now we're talking about 66 million that you'll have that you need in terms of cash on a monthly basis to support this activity. So there's a number of different more practical limitations that stands in the way of doing what I said in the beginning, which was, okay, look at it as a separable kind of problem, and then you can do stuff. However, if you can overcome that, then as a debt manager, you are also facing reputational cost, reputational risk that others do not. Because again, remember what you want to do if you hedge. You have liabilities in foreign currency, which basically means that you have swapped dollars into local currency effectively. So your hedge is selling local currency, buying foreign currency. So is that going to go over well with the populace, with the central bank, with others around you, if that's what you're actually doing? Because that is the risk reduction part of the activity. So that's where some of the solutions in terms of looking more broadly can come in and looking at baskets or looking at proxy hedges, because I'm sure that the central bank doesn't mind if you sell another EM currency against what it is that you hold. If the correlation is high enough, you can actually get away with that and get the risk reduction in the portfolio that you need. So those are some of the solutions that we are working on with people in terms of getting risk reduction into their portfolios, while at the same time taking institutional constraints into account. And these institutional constraints are important. And what I said in the very beginning was very naive. It's separable, but only to a certain extent. That these practical considerations that run a lot of, or that puts limits to a lot of what we're doing. It requires strong governance framework, like in Sweden, but then you can do stuff that can significantly reduce risk in the portfolio, because the volatility of the currency side is so high, and that's to answer your question, what's the right denominator, numeraire, for the benchmarking. It doesn't really matter, because inflation volatility is so low compared, well, not in some countries, but yeah, but in terms of the volatility on the currency side, it basically overwhelms it in most markets. I'm not talking about Venezuela, right? There are other problems there that are not solved by numeraires.
So Herman is going to give a short remark, and then we close.
Just a clarification. If you think in terms of the investor base you want to access, then issuing your bonds in other emerging market countries will not be practical. I was basically thinking about, say, take the example of issuing in dollars and then swapping those proceeds into a basket of emerging market currencies, some of which investors use them as a proxy hedge.
And now you got it. If that was what you were thinking about, that's exactly what I was saying. You get away with the having to sell your own currency, which has headline risk and everything else, and then you're accepting the basis risk between the hedge that you have. But in a crisis, you should still expect that to work, honestly.
So with that, I would like to give my thanks to the panelists. Thank you. This has been a privilege for me to be part of this panel, and I hope you also have some ideas on how to solve the puzzle. Thank you.
Yes, so we're going to have lunch together at 1 o'clock. It is in the auditorium, Preston, so you go down to the floor that we were at this morning, but go into the lobby farther to the big auditorium. There's, my colleague is going to guide you to the lunch. Thank you.